Welcome to Taking the Higher Road. I'm Leah Shaver, President and CEO of the National Transportation Institute. Each week, we interview industry experts and thought leaders who bring their insights to the driver lifecycle as we discuss the industry's greatest challenge, driver recruiting and retention. Your feedback is very important to us, and your kind reviews keep us on the hunt for more great talent to put in front of you. Please remember to rate and review Taking the Higher Road on whatever platform you're using to listen. I'd also like to thank and highlight the show's valuable sponsors. Their dedication and commitment to the industry and to this show are greatly appreciated. Today, I am excited and honored to be interviewing, again, one of the sharpest minds in our industry and someone whose immersion in the data behind trucking, transportation, the economy, the labor market, driver population, you name it, goes unmatched. Avery Vise, Vice President of Trucking at FTR, joins today's show for a conversation about all of those topics and more. Avery, I'm glad you're here to fill our listeners' knowledge bank of stats that they need to know. Welcome back to Taking the Higher Road.
Thanks, Leah. That's an embarrassing glowing introduction, but I do appreciate it.
I thought we'd start off on a high note for you,
Sounds
sir.
good.
Well, Avery, you've been on the show before, and you've been in the industry for over 25 years, so you are a man who needs no introduction, really. But to break the ice and to give our viewers and listeners some insights into what you do day to day, I do want to ask you about your weekly State of Freight podcast. Tell us what you cover each week and why folks in the industry should tune in.
Sure. Well, first, what do I do? It's a lot of internal meetings with colleagues and external meetings with industry participants. See how others are viewing the market. It's looking closely at key economic indicators and what signs they may be giving us on demand and capacity. We have a forecasting model. I'm not going to go into detail on it, but basically it helps us identify how much freight, how much capacity, what the productivity is, and leads us to a rate forecast. And there's a lot of number crunching involved, and I'm involved in some of that, but it's really my job to compare that output with other sources of information and kind of communicate it. So specifically the podcast, Trucking Market Update, it's one of our State of Freight podcasts. It's a weekly rundown, 15, 20 minutes usually, of some of the key trucking related and economic developments of the week. So we always look at how, and if we can, why diesel prices changed, why, what's going on with the spot market in terms of rates especially, but also volume. And we look at economic indicators that are, directly or at least closely related to freight. So things like retail sales, inventories, manufacturing, production, so on. And we dig into what's happening once a month with employment in trucking and the number of carriers entering and exiting the market. I generally stay away in the podcast from, what we would call news developments, but I do address certainly major regulatory developments that could certainly affect the market dynamics. And of course, if something like, Yellow shutting down or Knight Swift buying U.S. Express happens, I can't avoid addressing that as well. So if that sounds like something you're interested in, you can find the podcast at ftrintel.com/podcast. And it's usually uploaded by the end of the day on each Tuesday.
Got it. Well, let's dive into some of those indicators, starting with the macro labor market, as it has a big influence on the driver market. The U.S. unemployment rate has been under 4% for 2 years now, which historically is very low and indicates a very tight labor market. At the same time, we all see headlines every week, it feels like, about layoffs, both inside and outside of our industry. All of the buzz about layoffs aside, it doesn't really seem to be impacting the unemployment rate. Give us some context on how to cut through the noise that we all hear.
Sure. Yeah, it does feel sometimes like we're in two different realities when we read the news coverage and then we hear the actual data. There's a couple of things going on here. First, we do have to recognize that while the unemployment rate is quite low, the actual number of people who are unemployed is a fairly large number. In January, according to the Bureau of Labor Statistics, it was more than 6 million people. So, if hypothetically we have layoffs of 60,000 people, that's just an increase of 1%. And that's assuming no, increase in jobs to obviously take up some of those unemployed people. And of course, we do have job growth, and it's been solid and, in fact, recently quite robust. Another point here is that, companies often report layoffs that will be spread out over weeks or months. So, that gets spread out. It doesn't all hit at the time. But there is another factor behind low unemployment rates that's more concerning. Unemployment calculations are not based on the total working age population, but on the Bureau of Labor Statistics estimate of the percentage of that population or the amount of that population that consider themselves to be in the workforce. And that's done by survey. So to put it more simply, just because you don't have a job doesn't mean you're unemployed, according to the government. And that's kind of an important point. Even if total employment were not rising, that lower labor participation that we've seen since the pandemic would keep it depressed. And we're still about 1% below where we were before the pandemic. And that's basically 2.7 million people that are absent from the labor pool.
Interesting. Well, both FTR and NTI track the monthly pre-employment queries to the CDL Drug and Alcohol Clearinghouse as a measure of driver hiring activity. Throughout 2023, the trend line was higher than in 22 and 21, despite the ongoing freight market lull. The year did end with a dip in hiring activity, although based on the few years of historical data, December seems to be a low month, which is understandable given the holidays. What are your thoughts on what 2023 numbers mean relative to the recent stronger freight years, and what are your ongoing expectations?
Sure. So pre-employment queries, that's a hard thing to say sometimes. Pre-employment queries were higher in 2023 than they were in 22, but I think the more important comparison really is between those 2 years in 21, because those were sharply lower. And I think, a lot of people might find that, hard to accept given how strong the freight market was. But in fact, that's really one of the reasons. The pandemic was still a factor in worker availability, of course. But really, the other dynamic that we have to keep in mind is the number of newly authorized carriers entering the market. So just strictly from how the clearinghouse works, when a driver leaves a trucking company to get his or her own authority, there's no query involved in that because, the driver is not hiring himself or herself. There is, however, a pre-employment query when the carrier losing that driver tries to reseat the truck, but there weren't that many drivers available to hire back then. So that dynamic shifted in early 2022 because of soaring diesel prices and falling spot rates. But the upshot is that, we had a lot of those drivers get picked up by the larger carriers that were still looking for drivers. So we had displaced drivers needing jobs and we had carriers still needing drivers. And so that's why we had strong pre-employment queries in 22 and 23. Now, where are things going? As you pointed out, December's weakness probably is mostly seasonal, but I do think that it's notable that December was 5% below December of 22, and in fact the lowest since December of 21. When we look at our forecast of a sluggish freight market, we probably will see queries lower this year than they were in 23. That's not because of a lack of drivers wanting jobs, but probably because there are fewer jobs available for them. Payroll and employment in general freight truckload has been on a general, fairly gradual, but definitely downward trend since May, and I would expect that to continue.
Well, that brings to mind more questions. I think they're going to unfold here. So sticking with employment data in the context of trucking and drivers, I want to ask you a few more questions on that topic, but we need to unfold a few other layers first, namely freight demand and trucking capacity. Those two have been out of balance for going on 2 years now. So trucking's been in this downturn, freight recession. I think you just said two different realities, which I liked. Market correction cycle, vibe session, whatever term you want to use, rates tumbled and haven't recovered. And that's put financial pressure on a lot of companies in our industry, both big and small. So let's cover the capacity side first. The industry has shed some capacity, at least in terms of carrier count over the last year, but most of those carriers are in the smallest companies in the industry, i.e. 1 and 2 truck carriers. At the same time, total carrier count for the other fleet size cohorts has grown. So it seems like larger carriers are mostly absorbing those smaller carriers when they decide to hang it up. What's your take on the capacity correction? What are you seeing in the data? And what are you forecasting from a capacity standpoint for the foreseeable future? And this might get quoted across the industry because I think this is the number one burning question of all folks.
Well, I think you have hit on what I've been saying for months is the fundamental takeaway, which is, yes, we see a large number of, primarily, but not solely, small carriers exiting the market, but the drivers displaced by that have, for the most part, found jobs elsewhere in the industry. A lot of that does go back to the point, it's one of my other big points, and you will hear me say it several times, is that freight, while not growing, is also not falling. And so we basically have, as the capacity shifts, we still have a need for drivers to haul the amount of freight we have. We just have them in different areas. So, let me go back to my last point before to your last question was, I did say that truckload employment is falling, but it's only down, 1.5% or so since May. And May was essentially an all-time high. So, most of the surge we had, of course, was in the spring and summer of 22, but we kind of held on, at least through May, to all of that. And even today, we're still 4.6% ahead of February of 2020 in general freight truckload employment. And that does not include all of those carriers that are still around that were created in, primarily in 2021, because those don't show up in the BLS data. They're not generally participating in the unemployment insurance program for the most part, and therefore we're not even looking at that number. So basically, what I'm suggesting is that yes, many of those drivers were simply hired by larger carriers. And if we look at the I think you and I are looking at the same data, but probably doing it in a different way. But I think it shows much the same thing, which is that if we look at the smallest group, let's say 1 to 5 trucks, by the middle of 2022, they were 62%. The drivers associated with those carriers were 62% higher than before the pandemic. But larger carriers had basically recovered only to where they were before the pandemic. So we've seen growth since then. And if you look, July of last year, we were down about 10 percentage points from the peak for that smaller group. But the larger group, the 101 plus, was up 2%. So we've seen that basically shift. And we have seen since the middle of last year a decline. And I'm excluding, by the way, yellow in this analysis because that would obviously skew things. So we are seeing a decline, but again, it's a relatively slow one. As it relates to capacity, we tend to frame capacity more in terms of the dynamic between available trucks in the trucks we need. It's a metric we call active truck utilization. It's specific to Class 8. Right now, utilization is roughly 89%. That's several points below the 10-year average of 92%. And we don't expect utilization to get back to even the average until early next year. And it's going to be probably another, several months beyond that before we're at any point where we're going to see some, what I would call substantial upward pressure on freight rates.
That was a lot to unpack, and I'm telling you, you're on fire today with a lot of quotes. So let's keep going. You told me recently that a capacity correction alone won't be a catalyst for rates to rebound. Give us an update on the demand side and why demand needs to recover for rates to grow again, aka are there signs of life for freight volumes? What is the missing piece in the economy to spur a freight demand rebound?
Sure. I will say that in theory, it is possible to lose enough capacity to get an inflection. But we haven't ever really seen it. We had a big period from like late 90 or 2015 through through much of 2017 where we were in that situation and we got no inflection until late in that year. And that was primarily driven by the hurricanes. So it is just not really feasible to get that kind of inflection in. When I say inflection, I'm primarily talking about the stress that's going to create higher rates. So yes, for freight, right now we are not really forecasting any significant improvement in freight until at least the second half of the year. But there are definitely some upsides that could occur. One is if we continue to see a cooling of inflation, that's going to mean greater buying power for consumers. If we have a reduction in interest rates, that would also help both business investment and residential construction, as well as consumer spending. I wouldn't hold my breath too much on that happening soon. I do think the Fed's done raising rates, but I'm not sure we're going to see rate cuts that soon. Automotive is another possibility. It's a little unclear where we are going to land after the recovery from the UAW strikes, but definitely signs are at this point that we could end up at least stronger than we were before second quarter of last year when we had a kind of a spike. Retail inventories are very lean. That's, good news for freight because of the need for replenishment. I think though a lot of people put a little too much emphasis on inventories because an inventory rebuild generally is done within a quarter or two. It's not a sustained growth like you get with consumption, but hey, we'll take it. And I think there's the infrastructure bill that I think is really just starting to create activity in freight. Now the freight is going to be very, much localized to short haul, like bulk operations and to somewhat lesser extent flatbed. But I think if we want to look at it more broadly, just the economic activity that surrounds that is going to have a follow-on, trickle down effect, if you will, to freight. And then last but not least, I think job growth. We've seen that accelerate in the last couple of months, and that is definitely good news for consumption and the economy in general. Now, there are downsides in that, and I've touched on them, which is stronger freight growth can lead to inflation, and it can keep the Fed from reducing interest rates. But I think by and large, that's outweighed. So I think that's a way to look at that.
It's a pretty good summary. This one's quick, but I have to get your opinion because I've heard this take several times. The downturn in trucking currently is worse than the 08-09 Great Recession. I don't want to color your opinion, but I can hardly contain my objections when I hear that. What is your take?
No, and yeah. So the question may be quick, but I'm not sure my answer is all that quick. But I'll try to keep it short. I would definitely agree with you. The overall impact on the industry that is definitely not on par with the Great Recession. I think there's definitely some recency bias involved in that. But, and here's where things get a little complicated, it also does depend on how you want to define things. If by downturn you want to say, what is the difference between the peak in rates and the trough in rates, then the statement actually technically is true. But that's because rates soared to such high levels, unsustainable levels in, the second half of 2021 and especially the very beginning of 2022, where you did start to see spot rates coming down, but you were still rising in contract rates. So if you want to compare that and look at just the difference, just the delta, then yes, that's true. But as I said, the obvious problem with that is that, you're coming off an enormously high base. It was an unsustainable level of rates. And if you want to just look at where rates were, truckload rates in the first quarter of 2022, which was the peak of the current cycle, were about 50% higher than they were in the third quarter of 2008, which was the peak before the Great Recession. So now, one other thing, I know a lot of carriers are going to object that I'm not looking at costs. I'm only looking at rates. And I think that's a fair point. But there's also another big point here, and that's volume. And we haven't really seen any decline in truck loadings since the peak. It hasn't grown, but as I said, but it isn't going down either. It's really holding very steady. That's not what we saw in the Great Recession. We saw a very big drop in freight in 2009, and that was actually off, drop in freight in 2008, and even in 2007, a much smaller one. And so when we think of it more broadly, revenues are a function of rates and of volume. It's just no way, in my mind, that things are worse today. But yes, I mean, if you want to make that case technically, yeah, you could. But I think it is. I think it's a very misleading case to try to make.
All right. Well, thank you for your take on it. Let's dive into how the demand and capacity dynamics impact driver hiring and retention. Bear with me as I tee this question up. My question will probably be longer than your answer. You and I have both been in the industry for over 2 decades, cringe, and we see those cycles play out over and over. Even in the bottom of cycles, like the one we seem to be in right now, my team and I at NTI still have conversations with fleets of all stripes, all freight types, geographies, sizes, you name it, and they still say it's challenging to hire the drivers they need and retain the ones they have. The challenges are even greater the more nuanced the job, the higher the labor component, and the more stringent the hiring qualifications are. Part of the cycle is because of the cyclicality that we've talked about. The industry at large and companies individually focus on building a pipeline of drivers when times are good. We focus on and emphasize growing interest in trucking and attracting new people to our industry. And then when tougher cycles follow, we de-emphasize those. The pipeline ends up drained, and we wake up to heightened demand for drivers and a depleted pool to draw from. The current cycle, for example, is starting to feel a lot like 16 and 17, leading into the boom year of 18, and then the 2019 and 2020 down cycle, leading into the 2021 boom directly afterward. Stick with me here. It's so baked in our industry's culture and in many ways contributes to the cyclicality of supply and demand patterns. So finally, my question to you, Avery, is how can we work toward greater stability in the industry from the labor side throughout these up and down cycles? How do we focus on keeping new drivers interested in the industry and possibly disconnect that process from the bleeding edge of the up and down cycles? And why do you see those things as important?
Well, that question has a lot to unpack there. Although, actually, I'll just stick with what your actual question was, and I'll sort of avoid all your premise. And I do agree with most of that. One thing I will say is that, no, our current forecast does not envision us getting to a 17, 18 type dynamic, because of the interplay between the loss of capacity and increase in freight. But I will point out all of those upsides that I talked about earlier. If some or all of those were to come into play, our freight forecast is going to be low, and therefore, we could see that in this cycle. So, to your question, I frankly think there is an inherent cyclicality to the industry that is just impossible to get around, and so the idea of having perfectly stable capacity is just not going to happen. Now, there have been some ideas to kind of offset that, or sort of mitigate against that. One of them is index-based rating. That's became very popular with shippers during 2001 and 2018. Probably became more popular with carriers last year and 2019. And I think that's part of the point, is why I don't think it'll happen, is that to move to the current kind of supply-demand type rates to something like an index base means somebody's going to have to give up their leverage, and I don't see that happening. But we do have dedicated contract carriage, which is kind of a way to get to the same thing on a more bilateral basis between a shipper and a carrier, and that's become definitely more popular. And I do think it is a path to greater stability. So we're going to have to see how that plays out. There's certainly stresses on that because of swings in rates as well, but it's definitely become more popular over time. Now, as for expanding the pool, I don't know that I have a whole lot there to add that most of your audience doesn't know as much or more about than I do. I do think that we need to figure out some way to have a path, right out of high school, because, as long as, long haul trucking is a plan B for everyone, it's going to be a problem. We also have to recognize that the lifestyle associated with over the road trucking is a barrier to a lot of people. So, ways to deal with that, or to get the kind of density you need to do relays, for example. Unfortunately, that may mean carriers working together in getting that kind of density. That might be a barrier to it happening. But bottom line is, things like relays, things like dedicated, add more predictability, and I think open the industry up to more people. Obviously, many drivers do like the sort of long haul, irregular route lifestyle. But I don't think we're in any danger of losing enough jobs to satisfy that. And then, there's one other hurdle. You and I have talked about it before. And that is the legalization of marijuana. I do applaud ATRI for kind of wading in sort of gingerly into this topic last year, suggesting that, if we could get a nationally recognized impairment test and new standards, that would help. Of course, that runs counter to what a lot of carriers are doing themselves, which is using air testing instead of urine testing, so they can catch more drivers. So there's kind of a lot going on in that. So it's unclear, but as we see marijuana become more and more prevalent, it is going to be more difficult, to attract drivers, unfortunately.
I have no arguments at all. And I want to tell you that my fellow board members at the Next Generation in Trucking Association are all going to clip your quote about plan A for trucking and not plan B. So thank you for that. We're gonna repurpose. Let's talk trucking demographics and driver count for a minute. You spent the weekend diving into data from the Department of Labor about trucking employment. What were some of the highlights that you found in the data, and what should the takeaways be for our audience here?
Sure. Without going into a whole lot of detail, let me just say that this data we get once a year in January, and it's the only data from the Bureau of Labor Statistics that looks at the entire industry and not just the payroll side of the industry. So, all the data we get each month on payroll employment does not address, leased owner operators, and it doesn't address the vast majority of sole proprietors or other very small operations. So it's kind of interesting stuff. Now, unfortunately, it's an annual average, so it isn't tremendously useful in getting sort of a trend, but it's a good snapshot. It's also the source of the data that we read from the government on age, gender, race, and ethnicity. So, it's obviously closely looked at and widely debated, I might also point out. So I'm still digging through the data, but one thing that really caught my eye was that the average trucking employment last year was down 51,000, but the average number of people in truck transportation aged 20 to 24 was up 19,000. That's an 18% increase. And every other group was down except for 55 to 64, which was up about 5,000, and that's obviously a much smaller percentage too. And the only other year that we saw an increase that was larger than that for the 20 to 24 group was 2019. And that was when employment was up by 21,000, which was about 25% almost. So when you look at this, you think of 2017 and 2018, and you think of 21 and 22, and I think you kind of get a similar dynamic there, which is that, the industry is pushing, trying to bring in new drivers, and it finally pays off. The big question, of course, is, can you keep those drivers? That's a whole other conversation, which we've touched on, but haven't really gotten that heavily into. Let me make a big point here, though, and that is this isn't data on truck drivers. This is data on truck transportation. As you know, there's also data on a category called driver sales workers and truck drivers. That data actually contradicts this. It shows that driver sales workers and truck drivers aged 20 to 24 fell by 28,000, which is about 11%. And it was the only age group to see a decline except for 65 or older, which was down by about 9,000, which, was understandable because of retirements. So, we have an issue though, that just like the truck transportation industry is broader than heavy truck drivers, driver sales workers and truck drivers is broader. And which one is better? Well, I did some math, and I would say that basically 70% of truck transportation is heavy truck drivers, 56% of driver sales workers in truck drivers are heavy truck drivers. So if you have to pick one of them, it would be truck transportation, I would say, but neither one of them is particularly, satisfactory as a proxy. There's still a pretty big gap there between the total, and with the percentage of those that are drivers. But, I think it's probably closer. One final point there is that, I did look at the data on, women in trucking, and, it's pretty different depending on which of those you look at. So, 6.9% of driver sales workers and truck drivers are women. 11.9% of truck transportation is women. So, arguably, based on what I just said, that 11.9% is closer for heavy truck drivers. But I think it's fair to say, or at least it's my belief, that the percentage of female workers in trucking who are not drivers is probably higher than the percentage of female drivers. And so that would tend to bring that down something below 12%.
I think the general consensus from all of those numbers is that maybe some of the targeted groups over the last decade are seemingly climbing. We hope, and maybe some of our efforts are productive. I'll use that word. Let's end on a fun note. 30 seconds or less. You're a big music lover. I see you traveling all over the place for concerts and shows. What's on the concert agenda in the next few months? Any good shows upcoming that we need to know about?
I haven't focused on that as much this year as I did last year. Among the major tours out there, I suppose the Stones and Billy Joel would be at the top of my list, but I also saw them in the 80s. So I'm not sure I want to, I think I might want to remember them as they were then more than now. In fact, I remember I saw the Stones in December of 1981. And I remember thinking how old they seemed. And, I think Nick was 37 at the time. And for me, as a freshman, or a freshman or sophomore in college, I was thinking that was ancient. So, but that being said, I did see Springsteen about a year ago, and I thought frankly it was as good as the one I saw back in, I saw him twice in 84 and 85. And, so maybe
he's still the boss is what you're saying.
He's still the boss. Absolutely.
All right. Well, Avery, as always, thank you so much for your time and for sharing so much market intelligence and your insights with us. I look forward to our paths crossing again soon.
Thank you.
And thank you for joining us on another episode of Taking the Higher Road. Stay tuned for next week's show when Jeremy Raymer will be joined by Ben Schill, CEO of Paper Transport, in what I am sure will be a fantastic conversation. Once again, thank you for the sponsors of today's show. And if you are interested in sponsoring Taking the Higher Road, email Jeremy at takingthehigherroad.com. Until next time, thank you for taking the higher road.